Mr. Duffy, thank you very much for your time today and to your management team. Before we get into the mortgage crisis figures, which is what the meeting is for, I would just like to recognise that there has been significant progress in AIB. Some of the figures you presented around loan to debt ratios, around operating costs of the bank, are all moving in the right direction. So whilst there's various things I will take issue with here, I think at a macro level, you and your management team do seem to be turning the bank around, and I think that has to be recognised. I would like to recognise that. The focus of the meeting today is on the arrears targets. As the Chair said earlier on, it was to look at how the banks are doing versus the targets that have been set by government. I believe the targets are a genuine attempt by the government to try and solve the mortgage crisis. Now, I happen to believe that the targets try and solve the wrong thing. The symptom is arrears. The problem is not arrears. The problem is that Irish households have too much debt relative to their incomes. And I have said consistently that targeting arrears as solving the mortgage crisis is not going to work. First of all, it's trying to solve the wrong problem. And secondly, I was not convinced that the banks would engage in it in the spirit that I believe the government wanted and that the central bank wanted, which was long-term sustainable solutions. So I just want to go back over the figures that have been presented. And Mr. Duffy, I take your point that this is a single quarter. And as you were saying to Deputy Doherty, maybe this is an unusual quarter. However, the purpose of this meeting was to see how the banks have been doing in Q2 against the government targets. So if we go through them, 8,600 offers have been made. Of that, 5,900 are legal letters seeking engagement. Now, I don't think, whilst I accept that those letters have to be written, I don't think anyone would seriously suggest that a letter saying you must engage with us counts as an offer of a long-term restructuring of their mortgage. And I imagine that when the central bank audit is done, they will conclude the same thing. I appreciate those letters have to be written, but I see no justification for suggesting that any of those letters are in fact an offer of a long-term sustainable restructuring to a mortgage. So I would take those 5,900 out. A further 1,000 are cash flow help and mortgage deemed affordable. So in other words, there was no restructuring. Either you helped them sort of find extra money to pay it, or you determined actually you have the money to pay this and you're choosing not to and you need to start paying it. There's a further 1,100 which are capitalisation of arrears and term extensions, both of which increase the profits to the bank and increase the payments from the lender. They're not a long-term restructuring. They're saying, you borrower have 2,000 in arrears, we deem you able to pay that if we roll it into the 150,000 you owe, therefore that's the long-term restructuring. Maybe in some cases that is the case, but in many cases, based on the anecdotal evidence I'm seeing on the ground, those kind of offers are not really long-term restructuring of unsustainable debt. And it's worth noting that both the capitalisation of arrears and term extensions lead to increased payments, actually, over the lifetime of the loan from the borrower. That leaves us with just 600 offers. And they're split between the voluntary surrender, and Mr. Duffy, I was delighted to hear you say that in the case of a voluntary surrender, AIB is taking the hit. So if a borrower, my understanding is if a borrower owes 200,000 and the house is sold for 100,000 and it doesn't look like the couple could pay any more, that AIB is saying, of the remaining 100,000, you no longer owe it to us. We are making a provision in our books and we will never come back after you for that money. We are legally surrendering the money. I'm delighted to hear that. And then we have about 143 split mortgages. So really, the long-term sustainable offers that have been made, as I see it, and obviously we can disagree on this, are not 8,600, they're 600. And certainly the one for me that is unambiguous, we can argue the toss on the cash flow help and the capitalisation of arrears, but for me what is unambiguous is the nearly 6,000 which are legal letters. I would much prefer AIB to have come here today and said, We haven't hit the targets. We're doing our best to hit them.
Sorry, Deputy Matthews, please.
But we're not going to pretend that this 6,000 legal letters are long-term sustainable offers. I think that would have been a preferable position for AIB to have taken today. So the voluntary surrender, I think, is good. I'm delighted here, and you might confirm to me my understanding is correct. The bank lets the couple or the borrower walk away from the difference, which leaves us with the split mortgage. Mr. O'Connor, you said that the split mortgage is less attractive than one may think. And I would say to you, well, of course it is. The split mortgage ultimately doesn't work for the economy. And obviously, Mr. Duffy, you said one of the core strategies of AIB is to return economic growth to the country. Here's why it doesn't work. The marginal tax rate is 52%. Okay, so let's talk about a couple. They have a split mortgage. Can I recognise the 0% being charged on the shelved portion? I think that is very welcome and very different to what Bank of Ireland is doing, for example, which I think is a disgrace. I'd like to recognise that 0%. I thought it was 1%. I'm delighted to see that it's 0%. Here's the problem. We've got a huge number of people out there. Deputy Spring was talking about it earlier. I calculate there's about 650,000 men, women and children in Ireland living in houses, be they residential, owner-occupied or buy-to-let, in arrears or restructured not in arrears. It's a huge problem in the country, and as we know, it's rising. Marginal tax rate, 52%. So there's 48% of any additional income left. So let's say, Mr. O'Connor, you get a split mortgage, and your partner may be out of work to raise kids. One of the parents may be out of work and think, I'm going to go back to work, or I'm going to retrain, or I'm going to work overtime, or I'm going to go and get a master's degree and get a new job. But we are going to better ourselves. Here's what the split mortgage does. It says the government, any additional income for the rest of your lives, any additional income that comes into your household, the government's going to take 52% of it. Of the 48% that's left, we, AIB, are going to take half, 24%. So you're left with 24%. It's an effective tax rate of 76%. And I have yet to find an economist on earth who would say that a 76% marginal tax rate is not a massive dampener on economic activity. So that's my concern, and one of the reasons I think people are not taking up the split mortgage. The other problem is this. You have set the baseline for a reasonable standard of living, not against what a person earns, but against what the Insolvency Service has said, plus 20%. And again, the 20% is good. But let's be clear on what the Insolvency Service guidelines are. They are a punitive level of living during bankruptcy. They took the Vincentian approach, which was minimalist to begin with. They took things out of it, like a holiday. So you can't have a holiday. You raise your kids until they leave the house. In the ISI guidelines, you will never, ever be able to bring your children on holiday. You'll never be able to take a holiday yourself. They were always meant as a short-term, punitive standard of living. Now, unfortunately, what is deemed sustainable by AIB, and I think the other banks, is to say, it doesn't matter if you have 2 average industrial wages coming in, which would amount to about 70,000, or it doesn't matter if you're 2 doctors and you're bringing in 200,000. Everyone is going to this highly punitive standard of living, plus 20%. And if you earn more over your lifetime, you can have 24% of it. So my fear is that if that is the best we can come up with, an entire generation of Irish people who should be out there bettering their financial situation, creating jobs, entrepreneurs, are simply stuck in debt traps. So, after quite a long preamble, can I ask the following question?
Because you're about 4 minutes left.
Thank you.
Less, actually.
Thank you. The BlackRock stress test made €2.5 billion of public money available to AIB to deal with residential mortgages, just residential mortgages, 2.5 billion. The figures I've heard are that the write-downs to date are about 100 million, which is a tiny, tiny percent. It's about 4%. On the basis that the Irish people have made about 2.5 billion available to deal with residential mortgages, why has only about 100 million of that 2.5 billion been used to write down mortgages in distress?
And would you like to make some comment, and I'll wrap up on it?
Yeah. If I take a couple of your points, I understand the analogy around the 76% effective tax rate. We try to keep someone in their home. That is the principle of the MART targets. It is people who can afford to stay in their home. Is there an affordability level at which you can stay in that home? To do that, we have to look at their net income, and we have to have some consistent standard, reasonable living standard to work off, because we don't have the ability to make a call in every single circumstance, and if we're to be consistent, we need to have one. So I take your point. On capitalisations and term extensions, they are sustainable solutions. So I don't take your point on that one, to the extent that we model them out over the life of the mortgage, and the mortgage is sustainable to its original term or in a term extension a number of years, and the mortgage itself is sustainable and will pay down to capital interest will pay down to zero over the life of the mortgage. On the legal cases that we put in, and again I wouldn't agree that they're not, we are not required to offer sustainable restructurings to everybody under MART. We're required to offer sustainable solutions. To the extent that you cannot have an engagement with someone, to the extent that someone will not engage with you, or 50% of people won't provide SFSs, the solution will be a legal solution. It isn't a sustainable solution I think anybody wants, but that is ultimately what the solution will be.
No, Mr. O'Connor, but I want to be very clear. Yeah. Are you still, after everything that has been said at this committee, maintaining the position that a letter that says you must engage with us or we will be forced to take legal action counts in the spirit of what the government was trying to achieve?
To be clear, in terms of the letter that goes out, it tells somebody that they're entering a legal solution. Because they haven't engaged, as I said, there's nearly 2.5, 3 years of arrears on average, they've made no payment, we haven't had contact. So you're entering a legal solution. The only way you can exit out of that legal solution is by engaging with us to come up with another solution. Barring that, that will be the solution. You can't move from a legal solution into something that's unsustainable. So to the extent that somebody moves out of that, it will go into a different category.
I understand the logic. I understand why the letters have to be written. I want to be very clear on this. Are you saying, it's a yes or no answer, are you still going to maintain to this Oireachtas committee that writing a letter to somebody and saying you must engage with us or we will be forced to take legal action counts as what the government intended, which is a long-term solution offered? Are you going to maintain that legal offer counts?
Yes.
Okay.
Because out of fairness, I think the letter that we sent to the client puts them into a legal solution, and they can come out of that solution if they engage. But that is a solution to the issue. Would I want that to be the resolution? Absolutely not.
Okay, thank you. Mr. Duffy, can I ask, on the 2.5 billion that was made available to deal with residential mortgages?
I need to get you to wrap up now, Deputy, because I'm you're way over time.
Why has so little been drawn down? Why less than 100 million of 2.5 billion?
Part of it, as I explained earlier to Deputy Toomey, we had to build a capability, we had to deal with Justice Dunn, we had to deal with the issue of CCMA, and we had to get our volume of discussion and negotiation with each customer done to assess where they are. As we said to Deputy Toomey, we would expect this to be significantly ahead of a few hundred million in terms of the next 6 months or so as we come back to this committee, whatever the timing is. We expect that in dealing with issues now, as we have understood the whole book, it's unfortunate that these letters had to go out this quarter because it causes such angst, but that is the process of we were able to get to them. Here they are. And those will convert to solutions or a legal solution. But if we get through all of these, those write-offs will happen. If a half of that book turned out to be repossessions, there's going to be another chunk of write-offs associated with that. So we will see significant amounts of capital, which, remember, is you and your colleagues' taxpayers' money being erased.
So what is the total amount that the bank has now made provision for that it is going to write off? And by that I mean legally surrender any hold on.
We don't have a number that you're going to write off. That's not what we do. We have a valuation.
You must have a provision in your books for...
We have a provision in the books disclosed. Would you like to share that?
What is that?
Total provision. Please, Deputy Matthews, you have your own time to come in.
So just a couple of points. First of all, Deputy Donnelly, you're quite correct that the bank was capitalised under the Prudential Capital Assessment Review to be able to deal with these type of issues. And just to say that if we just take June 2013 as a snapshot, our capital base is well ahead of what the minimum regulatory requirements require it to be. And that's just so that we are able to deal with these issues as they arise. In terms of the overall provisions, the bank has disclosed and reported total provisions of 16.7 billion on its balance sheet. They include the order of 3 billion relating to mortgages. So those.
Sorry to interrupt you. Residential mortgages or resi and buy-to-let?
So owner occupied would be 1.4, and buy-to-let would be 1.5. And there's a balancing amount, which is a general provision, but that's not unique to each portfolio. So we've done that based on our view of cash flows, and that's where the write-off will come from as it comes out of the process that Brendan O'Connor is taking those customers through.
Again later on, Deputy.
Thank you very much.